In 1990, a group of entirely untrained portfolio managers selected a basket of 14 stocks. Over the next 2 years, their picks produced a nearly 70% gain, completely obliterating the returns of 99% of all professional equity mutual funds on Wall Street. These investors didn't have MBAs, they didn't have Bloomberg terminals, they didn't even have driver's licenses. They were simply 7th graders at St. Agnes School in Arlington, Massachusetts. The financial industry thrives on presenting the stock market as an impenetrable puzzle that only highly paid experts can solve. But the success of these students points to an uncomfortable reality for the professionals. The average person actually holds a distinct advantage. Peter Lynch knows exactly how wrong the professionals can be. As the legendary manager of the Fidelity Magellan Fund, he grew assets from $18 million to $14 billion, and his core philosophy relies on ignoring the experts. When one of the most successful stock pippers in history tells you that amateurs have the upper hand, it means unlearning almost everything we're taught about how the market actually works. Inside Joan Morrissey's class, the St. Agnes students divided into teams and managed theoretical $250,000 portfolios. By the end of 1991, their combined model portfolio achieved that staggering 69.6% return. They didn't achieve this by running complex algorithms or tracking moving averages. They reviewed data on companies whose products they liked and used every day. This table from Lynch's research breaks down the St. Agnes portfolio. The math is undeniable, a nearly 70% return versus the S&P's 26%. Look at the drivers. They bought Walmart because they understood the business, and the Gap because they wore the clothes. Lynch formalized this logic into his third principle of investing, the crayon rule. If you cannot illustrate a company's core business with a crayon, you shouldn't put it in your portfolio. Relying on tangible, observable businesses forces an investor to ignore opaque financial engineering. Instead, it strips away the guesswork and anchors your money to companies making actual things for actual people. This success scales far beyond a 7th grade classroom. Throughout the late 1980s and 90s, the National Association of Investors Corporation represented 10,000 investment clubs made up of ordinary adults. And year after year, a massive majority of those amateur clubs outperformed the S&P 500. Their method relied on strict discipline. They invested a set amount of money on a regular schedule, completely ignoring the daily news cycle and eliminating the urge to panic sell. Compare that quiet discipline to the environment at the annual Barron's Roundtable, where elite minds on Wall Street gather to debate the economy. Instead of picking good companies, the supposed experts spend their time trying to predict the next global catastrophe. This list of 1990 headlines captures the environment of fear. Drowning in articles about scraping by and the real estate bust, and fixating on Operation Desert Storm, professionals parked their clients' money in cash, completely missing the massive market rally. The professionals fail because they try to predict the unpredictable macroeconomy. The amateurs win because they ignore the world stage and focus tightly on the microeconomy of strong individual businesses. Most people avoid the stock market out of a very rational fear. We suffer from a cultural post-crash trauma syndrome, carrying the generational dread of the 1929 collapse. Lynch argues that this fear blinds us to the larger reality of the market. When you zoom out, the historical trajectory of the American economy is relentlessly, undeniably upward. This data table from the Ibbotson Yearbook compares historical returns. Across the most turbulent decades of the 20th century, the S&P 500 continuously outpaced the supposedly safe harbor of long-term government bonds. Over a 64-year period, a $100,000 investment in those safe government bonds would grow to $1.6 million. That exact same investment, left alone in the volatile S&P 500, would be worth $25.5 million. Choosing safety comes with a staggering cost. Market corrections happen, but a drop in the market is exactly like a drop in the temperature in Minnesota. It is an inevitable, recurring event. When winter comes, you don't burn down your house. You put on a coat and you wait for the thaw. Time and simplicity are your greatest assets. Ignore the apocalyptic headlines, draw your investments with a crayon, and wait out the winters. You already have what it takes to beat Wall Street at its own game. To actually execute this strategy, you have to know how to verify that the simple company you like is actually making money. And that starts with learning how to read a basic financial statement.